Ladies and gentlemen, welcome back to Crypto Boulevard. In this episode, we're going to take a look at Shield Finance, who will be launching on the 19th of May on paid ignition. They aim to be the go-to guy when you want to protect yourself from hacks, rug pulls, and market crashes. First and foremost, this is not financial advice. Always do your own research and wear big boy pants when you invest in crypto. If you happen to enjoy this content, if you think it's helpful, make sure to hit that like and subscribe button. Now with that being said, let's dive in. Shield Finance is a multi-chain DeFi insurance aggregator. I think we have all experienced major upsides and downsides when investing in crypto. Just look at the latest market pullback after all the tweeting surrounding Elon Musk. Personally, I have invested in a token that I figured out at the last moment that it was a rug pull, so I could have lost all my money right then and there. I have invested in paid version 1 token that got hacked, lost a lot of my funds, but thank God I got all my funds back and more, so that was a great job done by Paid Network. Now the cryptocurrency market is a very risky one. There is a huge problem surrounding hacks, scams, and market dumps that can crush any man's portfolio. Now you can try to insure yourself against these type of events, just like in the real world you can try to insure yourself in case, for example, your laptop gets stolen. But where to start? You can try to get protection by creating a package that will insure you against all types of events, but you will be investing a lot of time into searching and you will end up with different packages from different providers like, for example, Bridge Mutual, Nexus, Cover, and so on. You can try to protect yourself against the hack by auditing the code, but I'm guessing not everybody here knows how to do that or wants to do that for every project that you invest in. Even if you audit the code, you would still not be safe against rug pulls or, for example, an SEC investigation, like what happened to Ripple. In case of a market crash, you could set up a stop loss to protect your trades, so if a price falls below a certain value, it automatically closes that trade. But you have to be on an exchange like, for example, Binance to do that. The problem is that on Binance, in theory, your funds are not safe there because Binance can get hacked and you can lose all of your funds. If you trade on Uniswap and have your coins in your wallet, there's no possibility yet to set up a stop loss. And this is where Shield Finance comes in. Shield is an aggregator, so it will search across all different insurance providers. And you can choose from different insurance packages to fit your need and buy it with an on-chain transaction. Now we've seen aggregators before in crypto land, and they usually tend to drive more traffic to single providers rather than to work as a competitor. We've seen that before with, for example, 1inch, who are a DEX or decentralized exchange aggregator. Uniswap has benefited from all of the traffic generated by 1inch. ColdStack will drive more revenue to decentralized storage applications like Filecoin and Arweave. So I definitely think that all of the insurance providers like Bridge Mutual, Nexus, and so on will benefit from Shield Finance, which is the reason why I'm hugely bullish on this project. Currently, there is a huge demand for insurance in the crypto market. Hedgic has locked $100 million in the last 3 months, whereas Nexus has locked $300 million in the past year. But what we are missing is a one-stop shop with an easy interface and a wide selection of services. Now the second reason why I'm very bullish on Shield Finance is that it is a multi-chain project. The multi-chain narrative tends to work very well in crypto land. Just look at DFYN network that I covered about a week ago. That almost did a 100x in the first week until this last market crash stopped their run. So supporting the Polkadot, Ethereum, Binance and Solana network is a very big deal for Shield Finance. Now Shield Finance works with the Shield token SHLD. To create a stop loss for decentralized finance on Uniswap, they will create something that is called market crash protection. Let's say, for example, that you have a token X that you want to sell for $1, but the price drops down to 80 cents. You as a trader will be able to sell your 80 cents token into that MCP contract and retrieve your dollar. So it basically works as a stop loss. There will be different guaranteed prices and expiration dates where you as a user can choose from. Now the money in a market crash has to come from somewhere, and Shield's market crash protection relies on liquidity providers. There has to be a pool at hand where you as a trader can sell your 80 cents token for $1. Liquidity providers will deposit that money into an MCP contract as well, but they are basically betting that the price of token X will stay above $1 during the length of that contract. If it stays above $1, they would be making money. In return for taking these risks, liquidity providers will receive protection tokens on which they can get a high interest or at a later date sell for a higher price. Each MCP contract between traders and liquidity providers will have its own Uniswap market for protection tokens. Traders will need these protection tokens as well if they want to sell their token X when, for example, it drops to 80 cents. So why do you want to take this risk as a liquidity provider? Well, you can put your protection tokens that you receive in what they call a yearn vault, and you will get a high interest on it. After the contract expires, there are two options. Let's say, for example, the price of token X stays above that $1. The traders would not sell their tokens into the MCP contract, so basically the stop loss expires. The liquidity providers will now be able to take their money back from the contract. They will also have the protection tokens that they can sell, plus they have the interest made on these protection tokens. So this is a potential way for liquidity providers to make some extra money. Now if the price of that token X drops below $1 to, let's say for example 80 cents, the traders are now able to swap their 80 cents tokens for $1 in the contract and basically fulfill the stop loss. Liquidity providers will withdraw the 80 cents tokens, so these will be in their portfolio at a loss. They will have made money from selling the protection tokens to the traders, and they will have made money from the interest made on these protection tokens. So for liquidity providers, there is a big risk, but you can minimize these risks by charging more for their protection tokens, get the maximum amount of yield on these protection tokens. You can invest in tokens with a low guaranteed price, and you can invest in fundamentally solid projects, which probably have a lower volatility, and basically the chance is small that you have to pay out to any stop loss. And in the meantime, you make money from these protection tokens. Now, hopefully I was able to explain this market crash protection in an easy to understand manner. This MCP method does count as a stop loss for Uniswap, but it really reminds me a lot of options trading in the traditional markets. Basically, you're betting if something will reach a certain value like $1 at a certain time, like for example 1 week. Their web app is not live, so we're not able to see how everything works yet, but I do think that a stop loss on Binance works a lot easier. I'm also curious to see how gas prices are involved with these stop losses. If you have to pay $40 to set your stop loss on the Ethereum blockchain, then this might only be for the whales. But they are working on integrating with the Binance Smart Chain, where the fees will be minimal. Their mainnet will launch after the IDO in Q3, and integrating with the BSC and Polkadot blockchain will be later this year. Their team is looking to be brilliant and solid with enough experience, so I'm excited to see what they will come up with. When we look at the tokenomics, we see that there will be a total supply of about 969 million tokens, with their IDO price starting at 1 cent. The initial circulating supply will be about 64 million tokens with a market cap of $657,000. I can definitely see this market cap grow times 100 over time. They do have a buy and burn feature for their token, so in the future there will be less and less tokens on the market. On every insurance purchase made, there will be a fee. Half of that fee will be used to buy up and burn tokens every quarter, just like they do with BNB and the FTT tokens. So this is a deflationary asset. They also have a possibility for staking, giving you a 30% APY every year. All in all, being a one-stop shop and a multi-chain project are the two main reasons why I'm very bullish on this project. I like the fact that they are deflationary, but with 1 billion tokens, there is of course a huge supply. Their market crash protection feature is new in crypto land, and even though I personally like to try it out first, I think it can generate a lot of hype. On May 19th, they will launch on Paid Network, and soon after that it will be available for trading on Uniswap. Keep your eye out on this gem and trade wisely. That was it for this video. Let me know in the comments what you think of Shield Finance. If you want to see more crypto and if you think this content is helpful, make sure to hit that like and hit that subscribe button. And I will see everybody in the next vid. I'm out. Peace.